Welcome back, everybody, to Pump the Brakes. Welcome. If this is your first time here, my name is Andre Beckles, and I am the proprietor of Harari Wealth Management. And if you are returning, thank you for coming back. Before I jump into this show, I'd like to really just say, get some water. While you're here, please like and subscribe. You can share afterwards because I don't want you to dip out. So please like and share, and later on, like, subscribe, and then share with friends, family, colleagues, what have you. That being said, let's get into this. I know everybody has been waiting to hear the next Pump the Brakes, and we can call it the quarterly report. I waited a little while just to get to the end of the quarter, get enough economic data out there, let a bunch of happenings, and we've had a lot of happenings, so to speak, take place. So there's a little beef for the show. I'll try and keep it to about, say, 20 minutes. So let's go into Liberation Day, because today is April the 3rd. Markets just closed. And I'd like to talk about what you will see on your statements. And of course, since statements are going out right now, the cutoff date is the 31st. But if you go online, you can see your portfolios, or if you're thinking about investing, you can see, what valuations are out there inside the marketplace. So today was quote unquote Liberation Day. Other people will call it the day of slaughter. Nonetheless, slaughter, I don't usually use those terms, and I'm just using the terms that I heard in passing on the news, local news, business news. So let's just take a look at the indices and see how they close for just today, and then we'll look at year to date where we stand. So the Dow Jones today, April the 3rd, down 3.98%, so 4%. Year to date, it's down 4.7%. The NASDAQ, which is heavy with technology stocks and others, down 6% today, and year to date down 14.25%. S&P 500 has large size companies, mid-sized companies, small. That was down 4.8% today. Year to date down 8.25%. Russell 2000, which is all small size companies, down 6.6%. Year to date down 14.3%. And then the S&P mid cap, that's your middle sized companies, that was down, and I'll use the actual number, 6.66. This must be something there. And that being said, or it was a devilish day, so to speak. Year to date down 10.8%. International markets, which were open, if the bugaboo in the room, so to speak, would be tariffs. So the international markets were privy to some of the, if not all of the information as we were going to bed. So if we look at the London market, which is called the FTSE, today it was down 1.5% year to date. That is up 3.7%. The German DAX, that was down 3%, year to date up 9%. The CAC 40, and I say that properly because all my years of French, 40 is 40. So that was down 3.3%, year to date up 3%. The Nikkei, which is one of the main Japanese indices, that was down 2.75%, year to date down 12.9%. And the Hang Seng, which is out of China, down 8%, year to date down 0.25%. Some people will ask, why is the FTSE, the DAX, and the CAC 40, those European indices, why are they up versus, let's say, the major indices in the United States? And that has a lot to do with geopolitical things that are happening, whereas many of these countries are I nearly said slip of the tongue, but that's how they feel, former allies. And they're doing a lot more spending to build up their militaries, build up their own economy. So with that being said, that's why you're seeing that infusion of cash is helping companies in their countries, and that's why the indices are positive thus far for the year. If we look at the highs, for the year. So if we look since January 3rd, maybe was the first trading date, through today, if we look at where the Dow from its height, it's down 10% from its height for the year. The NASDAQ is down 18% from its height. The S&P 500 is down 12%. The Russell 2000 is down 22.5%. And the S&P 400 mid-cap is down 18.5%. Not year to date, but from their highs. We have 52 weeks in which stocks trade. So that's from the highs, because at one point we just kept hitting highs. You may have heard Trump always talking about, stocks are, doing great since I got in office. So those are some of the highs. And since Trump has been in office, these are real numbers. The Dow Jones is down 6.7%. The S&P 500 is down 10%. The NASDAQ is down 15.7%. And the Russell 2000 is down 16%. So that's since the day that he walked in office. Collectively, if we look back and when you get your statements, you can measure everything up against your very last statement, which would have been dated 12/31 of 24. So 2024 is one of the last times I spoke to on this podcast. The Dow Jones, for instance, was up 12.9% for 24. The S&P 500 was up 23%. The NASDAQ was up 28.6%. The Russell 2000 was up 10%. And the S&P mid-cap was up 12%. So those are the numbers by which you can live by, looking at your past statement, looking at your current statement. And what I want to go into very quickly is no short that I call the term chaos. So I think most people will agree with me. A lot's going on every day that you turn on your TV, and most of the things that you're hearing about are tariffs. And, with this last administration, when they were last in office, they did put tariffs in place. And actually, some of them were maintained by the next administration, which was the Biden administration. But these are new tariffs, and they've been proposed and pulled back. And, so there was a lot of capitulation, which was making the market very volatile. You had some days in which you were down, 2% or 1% in one indice, down 2% in another, maybe down 0.5% the next day, and then up 2% and up 3%. And sometimes this all happened in just one day, one trading day, just based on a lot of capitulation that was coming out of the White House as to what the tariff plan would be. So as of yesterday, April 2nd, we have an idea of what the tariff plan will be. There's a baseline of a 10% flat tariff for all countries. And then there's a breakout for other for specific countries where they feel that the United States is being taken advantage of. How true some of the numbers are, how they actually came up with the using a certain quotient to create those numbers. They're being questioned, and not by me, if you're hearing my opinion, but you're actually hearing it by a lot of economists all throughout the world, for that fact, but definitely even at home and within their own party. So tariffs, which I will say, equals taxes, which equals inflation. And basically, when you come into office and you say you want to lower inflation, you shouldn't start off by, raising the inflation by creating the volatility and uncertainty, and then creating tariffs that will push up prices. If there is any uncertainty that anybody has, the individual will pay the actual tax, because the company that is producing a good and it's being imported into our country, somebody has to pardon me, somebody has to pay that extra cost. And generally some companies will take in some of that cost, but at the end of the day, they're trying to maintain their profit margins, increase their profit margins. So they pass it on to you because they feel that it's a situation where, maybe it's a need versus a want, and then maybe they see where people are buying things even just based on a want, and they pass it on to you. As a consumer, you have the right to look at alternatives or curtail or change your spending habits, I always like to say. But that's one of the things that's going on in what I call chaos. Geopolitical events that are taking place, whether they be wars or thoughts of pulling out of treaties, coming up with tariffs, those are all geopolitical events that are creating uncertainty. And that uncertainty can also, as I talked about corporations, there's something called CapEx. Basically, in layman's terms, that's the money that companies look to spend to expand their business or to buy other businesses. If indeed there's uncertainty inside individuals' heads, they will start looking and say, hey, maybe we won't spend as much here, maybe we won't spend as much. And then, of course, spending is also a result of hiring, because you may need to expand your business. But if you even cut your spending, that may mean that you may lose jobs. So I know before I came onto this, after the market closed, you start hearing certain companies that were going to cut production, and then some companies that were going to lay people off. And that was more so in the automotive industry that I heard before. I believe Stellantis is one, which Stellantis is, that's Dodge, that's Jeep. I can't remember every brand that's under them, but that's something that they mentioned. Consumer sentiment, definitely, that is at a low. The Michigan consumer sentiment numbers came out a few days ago, and that is something that we saw there, that people are feeling wary as to what they should do with their money. How, should I spend it on a vacation? Should I buy a new car? Should I, maybe buy this house? Maybe, go on vacation. People are leery about spending their discretionary money for the mere fact that, they don't feel certain about the economy. And if you don't feel certain, you may change your spending habits. Now, if you're very wealthy, maybe you won't, but the average person is not very wealthy, and they make up the GDP, the gross domestic product, by spending. Consumer spending attributes to about 70% of the gross domestic product. So that's very important in a capitalistic society. What else? Inflation, higher cost. I touched on that with regards to tariffs. Uncertainty. I know markets never like uncertainty, and markets are generally comprised of institutional traders. So about 80% of the trading that takes place is institutions. The other 20% are individuals. So they like certainty with regards to economic, social, and political events. They don't like uncertainty. What else? Stagflation. Stagflation, you may be hearing about that. That's basically higher unemployment, high inflation, and then slower growth. That's what it is. It's kind of like a unicorn. Doesn't happen that often, but can happen. And, having these tariffs as a means of negotiation, so to speak, could create that type of scenario, because a lot of things are psychological. People, when they have uncertainty or fears, they change their habits. And then you could always have a contraction inside the economy, and that's called a recession. So those are some of the things that are out there. Just jumping very quickly into economic data, you have the CPI, which is the Consumer Product Index. It's an inflationary index. It gives you a gauge as to how the economy is growing or slowing. In February, that was up 0.2% versus an expected up 0.3. Year over year, it's just under 3% at 2.8%. Federal Reserve, it's one of their benchmarks as far as the inflation, and they look at that number to be down to 2 versus being at 3. We're ways away from during COVID where we were around 10-11%, but we're not at 2. Hence is the reason why you still see interest rates where they are. And I'll touch on interest rates in just a moment. Personal consumption index is virtually around the same. Year over year, it's at up 2.8%. So inflation is still sticky inside the economy. The job market, the job report will be out tomorrow, so that's April the 4th. The last report showed the unemployment rate at 4.1%, so kind of okay. Job creation is still there. Bond market, I text a few of my friends today that are in the mortgage business, just saying, hey, you gotta love the bond market, because just recently, over the past few days with all of this uncertainty, you've had bond prices skyrocket, and bonds are like slugs. The pricing is, as I like to say, they don't really move much. But over the past few days, prices have gone up. So when prices go up, that means yields, the rate of interest, actually goes down. The Fed hasn't cut rates, and I don't believe, that they will cut rates because of where inflation is, and if these tariffs create any further inflation. The only reason that you may see the Federal Reserve cut rates, if they do, is if indeed these actions that are taking place, which I'm going to touch on a few more of them in just a moment, if these actions that are taking place actually create a scenario where unemployment runs very high. One thing that I want to say is, I think I've gone through most of the data. But what I want you to, all investors, to keep in mind is that we're in IRA season. So with us being in IRA season, remember that your contributions, you can make them up until April 15th. You also can think about, as a strategy, consolidating and your 401k plans either to your current employer, or you can roll them over into your IRA. You have any questions on how you do that, you can just give me a holler. Again, little pause for the cause. Like, share, and subscribe. Required minimum distributions, either from retirement plans such as pensions, IRAs, 401ks. We're in 2025, so you have the calendar year to do that if you're 72 and older. The majority of all my clients are very astute with regards to their RMDs. They know when they're coming. We have it scheduled. If you are a newbie coming into being 72 years old, there's a feather in your cap. You have to take money out. If you have any questions, definitely hit me up and I'll tell you. Remember that your investments are long-term investments. There's always situations where there's changes inside the market that can affect your portfolios in the short term. Whether you are newly employed or self-employed and you're just starting off, or if you're retired, you are not a short-term investor, you're a long-term investor, because you still need to have your money work for you. So we have all, in some respect, lived through different times of volatility. Recently, we're looking at right now in 2025, we can go back to the housing crisis in 2007, 2008. We can look at the tech sell-off in 1999. We can then go back to, you can go back to 2023, where you had you had the banking crisis in Silicon Valley. So you have banks that were closing, and there was volatility in the market over that. I can go back a little bit further and think about the S&L, the savings and loan crisis in the 1980s, and also in 1980s, 1990s, and also in the market crash in 1987. So I say all of this to just hopefully for you to understand that, these definitely are worries that you may have, but this goes into my closing, my commentary, which has nothing to do with my back office LPL. This is my independent words. I just call it this too shall pass. My mother used to always tell me that when I did something wrong. She'd just look at me like, yeah, this too shall pass. I used to scare the hell out. Just those words used to scare me. But what it does mean is that whatever is in front of us will pass in the short term. So whether it be that you hear about the worries of the United States trying to annex countries, the downsizing of government, whether it be the offices without proper mandates, without any analysis, funding cuts, job cuts, the tariffs that I talked to you about, even with our allies, causing stresses in the economy, immigration debacles, the president talking about possible third term, the lack of experience inside, the staff that he's hired, unaffordable housing and no plan for that. Cutting social safety nets, whether it be Medicaid, Medicare, even possibly Social Security. All of those are things that make you think about, is this the end of the American exceptionalism? And, depending on how far you run off the rails, it could be, because there are other countries that will step in and start becoming mightier. I never want to say that, you had the end of the Roman Empire, but you can screw certain things up that can create that. But I'd like to say when push comes to shove, the people will make sure that this country is run right. And just as well, I do believe that at some point in time, Congress will get their act together. So with that being said, hey, this is the close of the show. I went over by just a little bit. I want to thank you for listening. If you have any questions, definitely either email me, contact me, or leave a message inside here. But this has been another version of Pump the Brakes. Until I speak to you again, peace be with you, and I hope everybody is safe and sound. Take care.